Discounted cash flow applications. This reading covers net present value, internal rate of return, portfolio return measurement, and money market yields. Let's start with the concept of net present value and internal rate of return. NPV and IRR are often applied across all fields of finance, but perhaps the most common and well-known application is in capital budgeting, where companies need to make decisions on which projects or investments to move forward with and what projects to reject. We'll talk about NPV first and then get into IRR. And to understand NPV, let us consider a simple example. Let's say that you invest 40 million today on a project which is expected to return 10 million every year for 5 years. So at time zero, there is an investment of 40 million, and then this is essentially an annuity, which we have seen in the previous reading. So I assume you have been through the earlier lectures and you know that an annuity of 10 million every year for 5 years, this will have a present value at time zero of 43 million. The net present value for this project is 43 million, which is essentially the present value of future cash flows, minus 40 million, which gives us 3 million. The reason we call this net present value is because we are netting out our cash outflow or our investment. So NPV effectively is your present value of future cash flows minus the present value of your investment. In this case, the investment happens at time zero, so the present value is 40 million. What the NPV of 3 million is telling us is that the present value of future cash flows is greater than the present value of the investment. And this clearly is a good thing because you are investing a certain amount, 40 million in this case, and the value today of what you will be getting in the future is more than the investment. So a positive NPV is a good thing. What if you realize that the initial investment is actually 45 million? That would mean that at time zero you spend 45 million and the present value of the future cash flow then is still 43 million. Here the NPV is minus 2 million. And this clearly is not good because now we are saying that the present value of what we will get in the future is less than what we are spending today, and therefore we should not proceed with the project if the initial investment is 45 million. Now, to make sure you've understood how to calculate NPV, you need to solve this problem. It's useful if you create a simple timeline showing the cash flows and also show the relevant interest rate, which is 10%. And what you effectively then do is find the present value of the future cash flows and subtract out the 750,000. So when we do the calculation, we get a NPV of minus 19,722. For NPV, you will notice this formula in several textbooks, and this formula essentially is a complicated way of saying that the NPV is a summation of all the cash flows. You will often see this written as this: T is equal to 0 through N. When T is 0, that is referring to our very first cash flow. When T is 1, that is the cash flow at time period 1, and so on. As long as you know how to do this, you don't really need to worry too much about this formula. If you have a complicated cash flow, or if you have a situation where there are lots of cash flows, then the method that I just showed you can be cumbersome and time consuming. So you need to know how to use the financial calculator to come up with net present value. Let us take the same question, and what you see here is the set of inputs you need to make on the calculator in order to come up with the NPV. This you have seen before. It is simply setting the calculator to standard mode. When you hit the cash flow button over here, that means that the calculator is now expecting input for the various cash flow registers. Here we are simply clearing the cash flow registers, and then 750 plus minus. This is essentially putting in a value of minus 750 for the first cash flow, which is actually CF0. And we are entering numbers here in thousands. So to save some keystrokes, we are just putting in minus 750. Then you hit the down arrow and enter and put in 200, then enter. What you have now done is told the calculator that the cash flow at time period 1 is 200. Then you will hit the down arrow once. You will now see a F01. This stands for frequency, and the default is 1, which you accept by simply hitting down arrow again. What that means is that this amount of 200 happens only once. If the cash flow of 200 happened over 4 periods, then you could specify a frequency of 4, but here it's only happening once, so we can simply accept the F01 or frequency of 1 and move on. We then specify 300. This is saying that the cash flow at time 2 is 300, cash flow at time 3 is 400. Once you have entered all the cash flows, then you need to specify the interest rate, and you do that by hitting the down arrow again and then hitting the NPV button, which is over here, and then you enter 10, which is the interest rate, and enter. What has now happened is you have told the calculator that the interest rate is 10%. You hit down arrow again and then the compute button, and the calculator will compute the NPV. The number will be a negative number, which is what we saw earlier. So we get a NPV of minus 19.722. A negative NPV, as I have emphasized before, means that the present value of the future cash flows is less than the investment. So that clearly is a bad thing, because if you are spending more money relative to what you will be getting, then clearly that project should not be executed. The answer to this question, should the project be accepted, is clearly no. Let's now look at the formal steps for calculating the NPV, and as long as you've understood what I've been talking about, this should be fairly straightforward. Clearly, the first thing to do is identify all the cash flows associated with the investment. On the exam, these cash flows will typically be given to you. In the real world, obviously, identifying the cash flows is one of the most difficult things to do, but on the exam, you will be given the numbers. Next, we need to determine the appropriate discount rate or opportunity cost. These are synonymous. If you recall the previous reading, we talked about the fact that interest rate can be thought of as a discount rate or opportunity cost. We then find the present value of each cash flow and then simply sum all the present values. So effectively what we have done is this summation of all the cash flows, and you have seen this formula earlier, but again, if you are intimidated by this formula, don't worry too much. What you really need to do is practice using the calculator so you can enter all the data and then compute the NPV. The NPV rule. For independent projects, this is where you simply need to make a decision on each project independently. The NPV rule is as follows. If the NPV of a project is positive, then you accept. If the NPV is negative, then you reject. And I have spoken about this a few times already. For mutually exclusive projects, this is where you need to make a choice between multiple projects. There, obviously, it makes sense to accept projects with higher NPV as long as NPV is positive. Moving now to the concept of IRR. The internal rate of return is the discount rate that makes net present value equal to 0. Let us understand this through a simple example. Say you invest $100 today and get $110 after 1 year. What is your internal rate of return? You can just do this in your head, where you know that 100 becomes 110 in 1 year. This is a 10% return. So the IRR is 10%. But how do we make sense of this statement up here? What is the NPV of this particular project? The NPV is equal to your first cash flow, which is minus 100, plus 110 divided by 1 plus a certain discount rate, and the discount rate such that this NPV becomes equal to 0 is the IRR. Notice that when we plug in 0.1, which is the same as 10%, the NPV is 0. So, in other words, the IRR is 10%, and 10% is what makes the NPV equal to 0. Take another simple example. You invest 100 today, and then after 1 year you get 10. After 2 years you get 110, which is essentially 10% of 100 plus the 100 back. Here again, clearly the return is 10%, so your IRR is 10%. And notice that this concept still applies. What is the NPV of this particular project? Here the NPV is minus 100 plus 10 over 1 plus R plus 110 over 1 plus R squared. Now the value of R, which is going to make this NPV equal to 0, is the IRR. And notice again that when you plug in 0.1, that is what is going to make the NPV equal to 0. So here again we can say that the IRR is equal to 10%. Now this is the somewhat complicated looking expression, which is essentially saying what I have already said. The NPV of a project is equal to the cash flow at time 0, which in this example is minus 100, plus the first cash flow, which in my example is 10, divided by 1 plus the IRR, and then you add the second cash flow divided by 1 plus IRR squared, and so on. If we had additional cash flows, you just keep adding over here. Now IRR is that return which will make this overall NPV equal to 0. We could solve for IRR when we have a relatively straightforward expression, but if this becomes complicated with several cash flows, then we will need to use the calculator. In fact, what you need to learn how to do is use the calculator, which is what we'll do in a few minutes. In case you are wondering why we use the term internal, it is because the IRR that you calculate, the internal rate of return, depends only on the cash flows of the investment. So in this particular investment, we are only using the cash flows of the investment to come up with the return. And the big benefit of the IRR is that it gives you a sense for the return on this project. Let us now do a practice question, and I want you to try this first on your own. The brute force way of solving this problem is to set up the NPV as follows: your cash flows, and then each cash flow discounted at a certain rate R, and then we need to set the NPV equal to 0, and then try to solve this equation and find the value of R such that the NPV is 0. That value of R would then be the IRR. While hopefully you recognize that this equation can be solved, but clearly it will take a long time. Perhaps you need to do this by trial and error, so there has to be a better way. The better way is to use a financial calculator. So we take the same question, and here is what we need to do. These are the keystrokes for computing the IRR. This is simply to set the calculator to standard mode. We hit the cash flow button over here and clear any past numbers in the cash flow register, and then we enter this information, and we are working in thousands. So the initial outlay is minus 150. So plus minus is to make it a minus. That is telling the calculator that the first cash flow at time 0 is minus 150. We enter the rest of the cash flows, 50, 100, 40. And then we hit the down arrow and the IRR button, which is right here, and compute. And this will tell us that the IRR is 13.11%. This method clearly is much simpler than what we saw earlier, but you still need to understand the concept that the IRR is that rate of return which makes the NPV equal to 0. Just like there is a NPV rule, there is also a IRR rule. For independent projects where you are simply making a yes/no decision on a given project independent of all other projects, if the IRR is greater than the opportunity cost, then you accept a project. The way you can think of this is, your opportunity cost might be 10%. That means that if you have some money to invest, your next best alternative is to invest at 10%. On a given project, if your IRR is 13%, then it makes sense to do the project, because what you are getting on this project is higher than the opportunity cost. Another way of expressing this is that 10% might be your cost of capital. That is how much it costs you to raise funds or raise capital. And then it makes sense that if the project returns 13%, which is greater than the cost of capital, then you accept the project. If the IRR is less than the opportunity cost, then obviously we should reject the project. So if it turned out that the IRR was 8%, which is less than the opportunity cost of 10%, then the project should be rejected. For mutually exclusive projects, we should accept projects with the higher IRR as long as the IRR is greater than the opportunity cost. IRR uses the opportunity cost of capital as the hurdle rate. A hurdle is something that you need to overcome. And if you think of a project, for a project to be accepted, it needs to overcome the opportunity cost of capital, or in other words, if at a given company the cost of capital or the opportunity cost is 10%, then for a project to be accepted, that 10% hurdle has to be overcome. So this rate is sometimes called a hurdle rate. Let's look at this practice problem now. A project requires an investment of 1.5 million. The project shall pay 200,000 per year in perpetuity. First cash flow 1 year from today. Cost of capital 8%. Before you hear the explanation, I want you to pause the video and try to solve this on your own. So here is what you need to do. The NPV for the project is equal to minus 1.5, and we are working in millions here, so that's the initial investment, plus at time 0 the present value of the future cash flows. What we are getting starting year 1 is a perpetuity of 0.2 million. The present value of this perpetuity is 0.2 divided by the rate, and the present value will be one period before the first cash flow. So the present value of 0.2 divided by rate is at time 0. The NPV therefore is minus 1.5 plus the present value of the perpetuity, and the IRR is the rate, which essentially makes NPV equal to 0. You do some basic algebra and end up with IRR equal to 13%. The next question is, should Bill invest? And the answer is yes, because the 13% IRR is greater than the 8% cost of capital. Some problems with the IRR rule. The IRR and NPV rules give the same accept or reject decision when projects are independent. So no issues when projects are independent. But very often projects are mutually exclusive and need to be ranked. Most companies have a budget and obviously cannot execute all projects. Therefore, they need to select which projects to do. To select projects, they rank projects and then do projects that obviously rank well. Now, we can rank using NPV or we can rank using IRR. The problem is that with mutually exclusive projects, the IRR and NPV rules might not rank projects in the same way. Differences can arise if the size or scale of the projects is different, or if the timing of the project's cash flows are different. Let's look at some simple examples. First, related to difference in size. You have two projects, A and B. With project A, the investment is 100 at time 0. At time 1, you get back 120. So clearly the IRR is 20% and the NPV, assuming a cost of capital of 10%, is 10. B is a much bigger project, so larger size, 10 times larger. The cash flow is this. IRR is 15% and the NPV is 45. So here, if you go by the IRR rule, then project A ranks higher. If you go with the NPV rule, then project B ranks higher. There is also a discrepancy if we have a difference in timing of cash flow. Project A is the same project as before. Project C now has the same cash flow, but we get back 170 at the end of year 3. Notice that the IRR is now 19% here, NPV is 28. So here again, based on the IRR, we would select project A, but based on NPV, we will select project C. So the question is, when there is a conflict between what IRR is telling you and what NPV is telling you, what should you do? The answer is, you should always rank or select based on the NPV rule. And the reason for this will become obvious when we study this concept in corporate finance, but very simplistically, there are some issues with the way IRR is calculated. So even though it is giving you a sense of the return, but there are some technical issues with IRR because of which NPV is the preferred method. Now, this doesn't mean that we don't use IRR. IRR is still valuable because it is giving us a sense for the return. But when there is a conflict, you should go with the NPV rule. Next section now, portfolio return measurement. As an investor, you need to measure portfolio returns. A very basic concept when we measure returns is that of a holding period return. Let's say that you buy a stock for $50 and 1 quarter later or 1 period later, the stock has gone up to 55, plus at the end of the period, you get a $5 dividend. So what is your holding period return for this 1 quarter or 3 month period? You made an investment of 50. That investment has now essentially turned into $60, between 55 for the stock and $5 dividend. So you made an extra $10 on your $50 investment. So your holding period return is 10 divided by 50, which is 20%. In terms of portfolio return measurement tools, there are two techniques that are used to calculate return. One is called the money weighted return and the other is called a time weighted return, and we need to understand both these methods. Let us first talk about the money weighted rate of return. The most important point to remember related to money weighted rate of return is that money weighted rate of return is effectively the IRR of the investment. So we need to determine the cash flows, which typically would involve investment in the beginning and then hopefully receiving money in the future. So all we need to do is input the cash flows into our calculator and compute the IRR. Consider a very simple scenario where at time 0 you buy a stock for $20. So that is your investment. Your initial cash outflow at time 0 then is minus 20. At time period 1, let's say this is 1 year later, you purchase a second share. So that is a cash outflow, and a dividend of 50 cents is received. So the net cash outflow is 22. At the end of period 2, you receive $1. This means that you are getting a 50 cents dividend on each share. So that's the plus 1. And you are receiving $47 from selling the 2 shares. So overall, you are getting 48 at the end of period 2. So what is the IRR? What you do is, in your financial calculator, enter cash flow 0 is minus 20, cash flow 1 is minus 22, and cash flow 2 is plus 48, and compute the IRR. What you should get is an IRR of 9.39%. Now let's look at the time-weighted rate of return. The time-weighted rate of return measures the compound rate of growth of $1 initially invested in the portfolio over a stated measurement period. Let's take the same example where we invest $20 and then we purchase a second share. We get a dividend at the end of year 1, and then we sell at the end of the second year. So the exact same cash flow, but when we calculate the time weighted rate of return, it will be a little different. To compute the time weighted rate of return, we need to see what happens to $1 which is invested at time 0. So notice that the investment at time 0 is $20. At the end of the first year, the stock has gone up to 22.5, plus there is a dividend of 0.50. This means that we have received a return of 15%. So 20 essentially becomes 23. So the return is 15%. $1 invested over here has now effectively become $1.15 at the end of one period. Then for the second period, we again need to determine the return. A stock that was purchased at the beginning of the second period for $22.50 became worth $23.50 at the end of the second period, and there was a dividend of 50 cents, which means that investment of 22.50 at the beginning of the period essentially gave us 24 at the end of the period. This amounts to a 6.67% return, and the 1.15 that we have at the end of period 1 can then be multiplied by 1.067, and that will tell us how much this initial $1 has become at the end of period 2. And the number we will get is 1.2267. But we need to say what the growth rate has been on average each year. For that, we need to compute the geometric mean. And we do that by multiplying 1.15, which is this number, by 1.067, and then raised to the power of 1 over 2 because we have 2 periods, and we get 1.1075. This means that each period on average the rate or return is 0.1075, which is the same as 10.75%. So the time weighted return is 10.75%. Let us look at a few subtleties related to the time weighted return. The first one is how to deal with inflows and outflows during the year. In the example I just showed you, the inflows and outflows were happening at the end of the year. Let's say that we have inflows and outflows at the end of every quarter in a year. So this is 1 year, and each point over here represents the end of a quarter. What we need to do is compute the return for every single period. So first quarter, the return, let's say, is 10%. In the second period, the return might be 5%. Then let's say it is minus 10%, and finally plus 20%. So what we do is, for each sub period within a year, we compute the returns, and then we figure out what happens to $1 invested at the start of the period. What is the overall return? And the calculation is straightforward. We multiply this by 1.1, because if there is a 10% return in the first quarter, then the dollar becomes equal to dollar times 1.1, which is 1.1. And then we multiply by 1.05 because there is a 5% return, and then multiplied by 0.9 because we have a 10% decline. So whatever value we have at the end of year 2 will go down by 10%, and we express that by multiplying by 0.9. And then finally the fourth quarter is good, up by 20%, so we multiply by 1.2, and this should give us 1.2474, or effectively the return over the year was 24.74%. The other tricky item is dealing with negative numbers, and we've already done that over here. Notice if the return is negative, then we simply multiply by 1 minus that number. So 1 minus 0.1 is 0.9. What you are not supposed to do is simply multiply the direct return numbers. You have to multiply 1 plus R1 into 1 plus R2 where R1, R2, R3 and R4 are the returns for each sub period. And if a return is negative, then this expression will simply be less than 1. So let's look at the overall methodology now for calculating the time weighted rate of return. We have a 2-year period where cash inflows and outflows are happening at the end of every quarter. And in a 2-year period, we have 8 quarters. And let's say that these top 3 items are done for you, which is price the portfolio immediately prior to any significant additions or withdrawal of funds. We are saying that all these significant additions and withdrawals are happening at the end of every period. break the overall evaluation into sub-periods based on the dates of cash inflows and outflows. So we have defined these as sub-periods. Calculate the holding period return on the portfolio for each sub-period, and that has been done. So we have calculated the returns for each sub-period. Then we are supposed to link or compound holding period returns to obtain an annual rate of return for the year. So if you take year 1, to come up with the number for year 1, we simply multiply 1.1 by 0.95 times 1.15 times 0.9, and this gives us, for year 1, $1 invested at the start of the year becomes equal to 1.0816, and then for the second year we multiply 0.8 by 1.3 and so on, and we have 1.248 for the second year. If there is a 0% return, then we simply multiply by 1. So $1 invested at the start will become 1.0816 times 1.248 at the end of year 2. To figure out the average per year, we have to take the geometric mean of the numbers for the 2 years. So you multiply them and then raise to the power of 1 over 2, because we have 2 years, and we get 1.1618, and the rate then is 16.18. So the time weighted rate of return in this example is 16.18%. Let us now briefly summarize the differences and similarities between money weighted rate of return versus time weighted rate of return. And this is a summary of what we've talked about. Money weighted rate of return is simply the IRR, whereas time weighted rate of return is the compound rate of growth of $1 initially invested in the portfolio over a stated measurement period. Both these numbers, however, are expressed on an annual basis. The money weighted rate of return depends on the timing and amount of cash flows. And you will understand this better when you work through practice problems. But clearly, if you are investing a lot of money just before a period where there is a tremendous amount of growth, then that is good for the money weighted rate of return. The time weighted rate of return, however, does not depend on the timing and amount of cash flows. So which method is better? The answer is that it depends. Let's say that you are evaluating a portfolio manager who has no control over when he receives funds to invest. If the portfolio manager does not have control over when to invest funds, then the time weighted return is the appropriate measure, because we should not penalize or reward the investment manager based on the timing of cash flow. So in this particular scenario, it would be appropriate to use the time weighted rate of return and not the money weighted rate of return. On the other hand, if you have a situation where the investment manager does have control over the timing and amount of investment, then it makes sense to use the money weighted rate of return. Let us take a look at this practice question now, and I want you to try this before you watch the video. So for the money weighted return, you enter the cash flows as follows. Cash flow 0 is minus 50 because that's your initial investment. At the end of period 1, you spend $60 more on a share, but you get a dividend of 3. So net cash flow is 57. And at the end of year 2, you sell the shares for a total of 150 plus you get $6 dividend. So the total cash flow is 156. Compute IRR and you should get 28.6. that is a percent. For time weighted return, you calculate the return for each period. At the beginning of the period, you invested $50 and that particular share was worth 60, plus there was a dividend of 3. That means you had a return of 26%, or your $1 here at time 0 became 1.26 at the end of the period. For the second period, the return was 30%. So the dollar here became 1.3 at the end. If you think of the dollar from the start of the year, that becomes 1.26 into 1.3. To compute the time-weighted return, we need to find the geometric mean of these two numbers. So we multiply them and raise to the power of 1 over 2 because we have two periods, and we get 1.2798. This means that the return is 27.98%.